No one knows what the total leverage in the stock market is, but we know it's huge after surging for several years. As you know, there are many ways to use leverage to fund stock holdings, including credit card loans, HELOCs, loans at the institutional level, loans by companies to its executives to buy company shares, or the super hot category of SBLs where brokers lend to their clients. None of these are reported on an overall basis. The only form of stock market leverage that is reported monthly is margin debt, and that's the amount individuals and institutional investors borrow from their brokers against their portfolios. You also know that margin debt is subject to margin calls, and apparently there have been a few margin calls since October and November. So let's take a look. While looking at this chart, note that according to FINRA, margin debt in October plunged by $40.5 billion, and this was the biggest plunge since November 2008, just weeks after Lehman Brothers filed for bankruptcy. Following the great financial crisis, this measure of margin debt has surged, reaching a peak in May 2018 of $669 billion, and this is up 60% from the pre-financial crisis peak in July of 2007, and it's up 117% since January 2012. Since the peak earlier this year in May 2018, margin debt has dropped by $62 billion, with a $40.5 billion drop in October alone. In the more than 2 decades, the relationship between stock market surges and crashes and margin debt should be obvious. Prior to the year 2000, stocks soared by stunning amounts, and people used margin debt to boost their returns. When stocks plunged, the margin calls came, and these people had to sell their stock holdings into an illiquid and plunging market. Often, they ended up selling their best and most liquid stocks first and watched their trash stocks, well, get trashed. When it was over by 2002, the NASDAQ had tanked 78%. Over the same period, margin debt plunged 54%. A similar scenario played out during the great financial crisis, and now we have the everything bubble to deal with. But this money from these stock sales doesn't go into other stocks or other asset classes, and it doesn't sit on the sidelines waiting to jump in again at the next dip. Nope, it's used to pay down margin debt, and thus this liquidity just evaporates without a trace. October's plunge in margin debt was just a little dimple in the overall chart. Unwinding such a huge pile of margin debt and overall stock market leverage takes time, years, and they'll be interrupted with some brief increases that'll make everyone feel just a little bit better for the moment. So, for my 2 cents worth, stay away from margin debt and keep your eye on the others who do use margin debt. So for today, that's ChewDog Charts. Thank you.